Hello, ladies and gentlemen. Hello, everyone. I hope everyone is having a great time so far. And here at Admirals, we have this afternoon webinar with Mr. Paul. Allow me to introduce you to a few things if you are new with us here in this webinar. First and foremost, I would like to inform you about the YouTube channel, ladies and gentlemen, here at Admirals Global. Let me copy and paste the address so it's easy for you. So here is the YouTube channel. Please make sure you subscribe. And if you scroll down here at Trading Spotlight, you will find all the webinars, all mainly already done. And here are the recordings, so you can go back and rewatch them. It's a series of price action trading. Paul is an exceptional price action trader, and you couldn't have someone better to explain you and help you get your head right about price action trading. So please make sure you subscribe on the YouTube channel, enable the notification button, so you can receive all the new uploads on the channel. Next, we do have the Admirals Global Instagram account. I would like you to know about. Here it's the link. We put valuable content pretty much on a daily basis, either in terms of posts, on reels, or on stories, about market perspective, about fundamental analysis, about all the webinars we're going to do. So you make sure if you miss to register for a webinar, you have the opportunity to receive some notifications on the YouTube. And the last one, please, it's the Telegram channel. That's the Telegram channel. Here is on the chat box below. Now we enable on the Telegram the message button. You can use it from your mobile devices, not from the web. On the web, it doesn't show up. And it's really useful social media to get some information about what we do here when we bring out some content. So at this stage, I would like to give it back to Paul, Hello, Paul. How are you?
Good afternoon, Theo. I'm very well, thank you, and hope you're well also.
Great. Yep. I'm very well. Thank you so much. Okay, I think I sorted it out. So try to share your screen.
Excellent. All right, I'll do that, and we can get ready to fire off, so to speak, hopefully.
Fantastic.
Excellent. We're in business. Thank you. Thank you for the introduction, Theo. Good afternoon, everybody. Great to see you all here today for our session. As the slide says, we're at Paul's Ultimate Price Action Guide, and today we're on session 11 already, which is about managing our trades. Okay, so each week what we've been going through in this price action guide is a bit of a switch between sort of the hard skills of trading. Okay, so basically, identifying trends, identifying setups, putting trades on. And then also an element of the kind of soft skills, which is about building trading plans. It's about getting yourself the right routines. Okay, it's about having your plan sort of take care of actually managing our trades, more of which we'll touch upon later. It's great to have you all here. Okay, really pleased to see so many of you joining us. Remember, here we are at Admirals, all right, a Forex and CFD broker with global presence and local support. Licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and giving the opportunity to engage in markets using both MT4 and MT5 platforms. Any questions about Admirals, please get in touch with your account representative and they'll be very happy to help you. So we'll talk a little bit about today, right, what is price action trading, but I would hope by now most people who are joining our sessions, okay, and getting a little bit of a hint and understanding. Today, it's about managing our trades, all right? And we'll talk more about that in a moment, but we'll discuss about, well, what do we need to cover? What is the best practice for managing our trades once they've actually traded and once they're sort of in the market? And we'll talk a little bit about that, and I'll share with you some of my own experience. And then if there's time at the end, we'll have a look at live markets. Everybody likes to have a little look at the live markets to see what's going on. It's a bit of an interesting afternoon that we have occurring at the moment. As always, I appreciate that we have a broad range of experience who join us for our sessions here. So we've got people who've been trading for a good while, got a good experience, and also we've got new traders, beginner traders, all right? So trying to understand, just about markets and about trading, and as well about price action. So there'll be plenty in here to help you in terms of managing your trades, right? But even for the advanced trader, there'll be something that will help sort of, move you forward as a trader. And I also realized that, here we are with the English speaking webinars here, but it's a truly global audience. Okay. We have people joining us from all over. It's great to have you here. You're all very, very welcome. All right. And it's I hope that you're having a good year in what has been rather interesting and volatile trading conditions. So without further ado, for those who don't know me, my name's Paul. I've traded for many years, traded for funds, trading for clients. Primarily, I like to focus on FX indices, commodities. They would be my favorite sort of asset classes to trade. Longer term trading, I tend to be a trend trader. Shorter term intraday trading, I tend to be a reversal trader. That's how I like to work, and I'll be sharing my kind of experiences with you as we go through this particular series. So as the slide shows, we're continuing our series on an ultimate price action guide, all right, helping traders understand and utilize price action in their traders. Very often I find that for new traders, beginner traders, it's easy to get a little bit overwhelmed and intimidated, okay, by all the data that's out there, all the information that's out there, okay, all of the indicators and everything that can be put on your charts in order to be able to analyze markets and engage and trade markets. And what we're here to do is, in some respects, is to try and strip it away, okay? Strip a lot of it away. And so that, with just a little bit of education, a little bit of knowledge, a little bit of insight, understanding how price action is formed, how candlesticks are formed, and what they're telling us, then it becomes a little bit easier for us to analyze and understand markets. So each Wednesday, 2:00 London time, we'll be building upon the previous session to sort of help you become educated, informed about how to use price action in your trading. And as I said, it's a mix, okay? 1 week we'll be doing like hard skills, okay? So it'll be like setups, looking at charts, okay? Just the bits that, you need, but then also the soft skills, which sometimes new traders underestimate, okay? Or they don't maybe necessarily understand the importance of it. They don't recognize it. But actually, those of you who've traded for a good while will realize that those soft skills are what enable you to make the most success using the hard skills that you'll have learned as well. It does all work together. So, we're trying to, as I said, this is supposed to be an ultimate price action guide. So it's not just about, finding the next pin bar in the market. It is about all of the element about, understanding markets, all right, all about managing money, which is part of an element of what we're doing today, managing risk, managing myself, okay, about understanding your own trading psychology and what you need to do to be the best trader you possibly can be. Because that's what I'm here to do, is to help guide you to become the very best trader that you can be. That's what we're looking for and want for you. So if you're joining us for the very first session, and you're still new to trading and understand, well, what on earth is price action, Paul? It's a very simple, basic means of market analysis using price movement over time. It is popular with both retail and institutional traders. You'll find that they all quite happily work with it. And what we're doing is, the price action is basically that change in price over time. And what we will be doing mostly, okay, is typically focusing on price action over the last 3 to 6 months, right? But also respecting longer and shorter term price movements. The reason we're doing it over kind of like 3 to 6 months look back is that I do recognize that a lot of the people joining us here today, they're not trading full time. They'll be trading around their day job. They'll be trading around family commitments, life commitments. And so they might only be doing 1 to 2 hours of trading a day, okay, just, around those other commitments. And so, with that in mind, this is an opportunity to have a little look back over the kind of longer term trading timeline. So things like weekly, daily, 4 hourlies, to be able to do that. But everything that I share with you, all of the concepts and thoughts and ideas, you'll find me here talking about constantly about they are time frame and instrument agnostic. Whilst I might focus on those particular time frames and those particular asset classes like FX, indices, commodities, I concepts will work across all timeframes and all instruments. And so as you develop your own skill set, as you develop your own particular style of trading, these ideas and concepts you will be able to work well, regardless if you're find yourself, trading 5-minute charts of crypto, or you're trading, monthly long-term charts of platinum commodities. Okay, doesn't really matter. The ideas and the concepts are the same. Take them away, learn them, practice them, utilize them in your own trading. Okay, take them forth and develop them, make them better, evolve. Okay, evolve these ideas, evolve yourself as a trader. That's what tends to happen with the very best traders. So we have covered quite a lot already, even we're up to session 11. We've looked at introductions to price action trading. We've looked at setups like the engulfing candle, the star formation, the key reversal setup, pin bars. Last week we looked at inside bars, right? So as I said, lots of those on hard skills, okay, but we also looked at some of the hard skills and soft skills, things like identifying a trend, preparing yourself, to make the most of opportunities in markets, managing risk, okay, which is crucial, and also about building trading plans. And today we're going to talk a bit about managing our trades. The great thing, as you heard my colleague Theo talk about, is that all of these videos are on the Admiral's YouTube channel, so be sure to go and check them out. If you've not watched them so far, if you've not seen them, well then by all means, okay, just go down and sign up for them there. Okay, watch them. All right, you might have joined us, but actually watching them again, all right, might actually, especially some of the hard skill ones in terms of some of the setups, might just help them click into place in understanding what they're doing, how they're operating, and how you can utilize it in your own trading. So in session 7, okay, which, as I said, is on the Admiral's YouTube channel, we dealt with risk management. For those of you who know me, those of you who've been joining these webinars for a while now will know that I'm always very, very consistent, very clear, very hard on risk management. Okay, you are a trader, right? A trader's job is to manage risk, and the better you're at managing risk, the better your trading career will be. Right, so we deal with risk management. Okay, we deal with about how crucially important it is. And if you remember, just the 2 very simple rules is that you never ever trade without stop loss. You never risk more than a small portion of your account on your trade. If you do those things, you will live to fight another day. Okay, you're human beings. You're learning a new skill. You'll make mistakes. You'll make errors. You'll make trades that maybe not ideal. That's fine, as long as you have stop loss in place and only risk a small portion of your account on one trade. You will live to fight another day, and that's the important thing. So we looked at that, okay, and that was risk management. Today we're going to look on the flip side of that, okay, and on the flip side of that, namely looking at reward. All right, reward. You've got risk to reward, okay, and we talked about that. Is that it's important for us as a trader when we're getting into trade to know your exits, okay. And there's an exit when the trade hasn't worked out. But there's also an exit when the trade is working out and it's playing your way, all right? And we understand about quantifying your possible reward, all right? Where is it that you're likely to take profit in your position? And, very simple, that is your entry price versus your exit price, if you were right, okay, in your trade in terms of the direction and the timing. So what are our options? What can we do? How can we manage this, all right? And there's a little bit of a deeper conversation to be had about that, all right, okay, which will come out in terms of how we talk. So what you will hear is how do traders manage the risk, okay, versus the possible reward. Sometimes you'll hear traders talk about it as the 3 R's, okay, the risk to reward ratio. I'm going to talk more about that, okay, because it is part of managing your trades. And I'll talk about my own experiences in terms of trading for funds, being on trading floors, all right, coaching and mentoring hundreds, perhaps thousands of traders over the years, all right. So just to see the experience that I have had and what I've seen is in terms of best practice, okay, and what I've seen in kind of as worst practice. But you'll hear me sometimes talk about 3 R's, okay, the risk to reward ratio. I just want to prop that up now, and we're going to talk about how do they manage risk versus reward, and how does that show itself when we come to look to managing our trades. Well, what I can say about risk to reward is it's a bit of a balancing act, and a lot of that is defined by your own risk profile. So you'll find that myself and my colleagues here, Theo and Jens and stuff, we can teach you an awful lot about markets, trading, okay, investing, technology, psychology, etc. We can teach you a huge amount about all of those kind of subject matters, all right? And you'll find most of that is, as I say, on the Admiral's YouTube channel. The one thing you need to learn yourself, though, is about understanding your own risk profile. We all sit on that spectrum, or that risk spectrum, okay? Some traders are very aggressive and very comfortable, all right, taking on lots of risk. Others are very, very cautious, okay? They will only take risk on, okay, if they're in the right space to be able to do that. And so everybody sits on that spectrum. And the important thing is to know where you sit. There's not necessarily any right or wrong, okay? It's about knowing who you are and trading in line with what your own risk profile is. Maybe some of you here today, are very aggressive, okay? You just like to be trading constantly. You like to be in the market. You like to take trades at the drop of a hat. Others here will be very cautious, okay? Very aware of risk, not very accepting of risk, and wanting to navigate their way through those kind of choppy waters of uncertainty. As I say, no necessarily any right or wrong. It's about knowing where you sit, okay? And then we'll talk more about how you can work on that. But it's something to understand in terms of it's a constant balancing act for traders, all right, between the managing risk and managing reward. And what we'll do is that we'll do a future session, and what you'll hear me talk about is like GBT, greed-based traders versus fear-based traders, all right? And that all filters through and into the kind of understanding the relationship between reward and risk. Remember what I said, you're a trader, all right? Traders get paid to manage risk. All right, you don't actually get paid to pick the superstar trades, the rock star trades that run. As a trader, a good trader, you are paid to manage risk, and the better you are managing risk, the better your trading career will be. So with that in mind, all right, you'll hear often, the old and bold traders talking about that old trading adage that, when you're in a trade, once you've taken a position, you should cut your losses and ride your winners. Everybody says it. It's a nice, glib, flippant trading quote. Everybody can say it. Cut your losses, ride your winners. But what we find is that actually most new traders do the exact opposite. They cut their winners short because they want to grab at any kind of profit, and they basically stick with their losing trades. They let their losing trades run, all right, because they hope, all right, that the trade is going to come back and actually go profitable for them. And that is a version of what they call loss aversion bias, all right, which is something we'll touch on in a future session as we go into looking at their biases. So, as I said, traders will all talk about cut your losses and ride your winners, but what you find is most new traders do the opposite, right? They grab at any profit they make, and they let their losing trades run, okay, because they will effectively hope that they will come back and go profitable for them. I'm here to say, and you'll hear me say it, when it comes to trading, ladies and gentlemen, hope is not a strategy. All right. Hope, and if you are basing your strategy on hope, good luck to you. You're going to need it. But I can assure you that, hope is not a strategy. All right. Hope is not a strategy. All right. So, and we will talk more about that as we go deeper into understanding the trading psychology of good traders. So, what can we do to help us with that balancing act of understanding reward to risk? What you'll hear me talk about is that I personally believe in asymmetric reward to risk trades, right? What does that mean? Okay. What that means is that, for whatever I'm going to risk on a trade in the market, I'm expecting a multiple return of that. So if I'm going to risk $100, I'm looking at the possibility to, generate $200, $300, $400, $800, okay, for my return. So it's asymmetric, all right? Okay, I'm going to risk 100 to make 200, 400, 800, okay, depending upon the strategy I'm using, depending upon how I'm trading, depending upon the market conditions, all right? There's elements that go into that. But why do I do that? All right, why do I do that? And I said I'm sharing with my experience and how I trade, okay, is that actually what it does is it helps me because it removes the need to be right on trades, all right? What it does is it takes the pressure off my shoulders. Now, what does that actually mean? How does that mean? Because what we find is that lots of new traders, they want to be right, okay? They have a real need, a real drive, a real desire to be right, okay? They want to be right 7 times out of 10, 8 times out of 10, 9 times out of 10, 10 times out of 10. Okay, they want to be absolutely right. And I've no doubt you'll have, come across, all right, adverts for trading signals that, offer you the opportunity to be right 98% of the time. Okay, and you'd think, well, that must be, absolutely fantastic, Paul. But, be careful what you wish for, ladies and gentlemen. That's what I say. Be careful what you wish for, because it is perfectly possible for you to be right 98% of the time, but actually still be a losing trader. Why is that? How is that? Because you're doing the opposite of asymmetric reward to risk. If every time you win, okay, every time you win $1, and every time you lose $100, well, you can be right 98 times out of 100. You can have that 98% hit rate, success rate, but you're still a loser. Okay, you're still, your trading capital will be down. All right. And this is what we find, and it's what I was saying earlier, is that we'll find new traders, they will grab at any sort of profit and hold on to their losing trades quite too long. Whereas actually I'm doing the opposite, and you'll find lots of good traders doing the opposite. Okay, effectively they are looking to basically to have, to risk a small amount with the opportunity to generate, okay, 2, 3, 4, 5, 10 times what they are. Okay. What that means is that you probably have a lower hit rate. Okay, you're right, probably wrong. You're right less than most other people, and that's fine. Okay, but we'll come on to that in a moment. But I find it takes the pressure off my shoulders. All right, if I only have to be right 3 times out of 10 to be profitable, that I find that very easy. I find that quite relaxing. I only have to be right 3 times out of 10. Whereas if you need to be right 98% of the time, okay, to make money, that becomes quite stressful. That puts a lot of pressure on your shoulders, ladies and gentlemen. All right, and that doesn't help when it comes to making good decisions in uncertain, high pressure performance environments. We want to make it as easy as you possibly can for yourself. So part of that is about understanding that kind of relationship between the risk to reward, the relationship between your strike rate, okay, how often you're right, and actually what you're actually able to generate in terms of your 3R, your risk to reward ratio. That's just, you've probably seen versions of this before, but let's just sort of bring up this whole the old pen here. Okay, so down here we've got the risk, the 3R, okay, the risk to reward ratio. All right, and along the top here I've got my strike rate, okay, my win rate, how often I am right. And so, not unsurprisingly, okay, if I'm only right 20% of the time, if I'm only right 2 times out of 10, well then if my reward to risk ratio is only 1 to 1 or 2 to 1 or even 3 to 1, I will remain non-profitable as a trader. But if I have a strike rate of 20%, anything above 4 to 1, okay, I'm at least breaking even, and 5 to 1 and above, I'm absolutely profitable. It might sort of, fascinate you to know that, huge, big traders that are mentioned in such books as, New Market Wizards, things like George Soros, Paul Tudor Jones, okay, they have strike rates of 20% and below, all right, 10%, 20%, okay, they have very, very low strike rates, but they're able to generate, their reward to risk ratio is like normally 5 to 1, 10 to 1, etc., and above. At the opposite end of the extreme, okay, if you have a hit ratio where, you're right 60% of the time, well, even if you're only, even if you're just basically your reward to risk ratio is 1 to 1, you'll be profitable. In fact, you'll be profitable anything, not unsurprisingly, above 50%. Okay. But, if you have a strike rate of 60% and, you're able to be right, 3 times at 1, well, you can be profitable 4 times, 5, you'll be profitable, very profitable. Okay. Very profitable indeed. And as you develop as a trader and you become a little bit more subjective in taking your trades in terms of, understanding which trades work for you, all right, and taking more of them, and which trades don't work for you and basically cutting them out, just good business practice. All of that can actually help you, all right? That can help you in just nudging your profitability, your equity curve in the right direction to have the right trajectory. So what I tend to find is that, people want 5 to 1 reward to risk ratios, and they still want a 60 to 70% hit ratio as well. Delightful, lovely. If you're achieving that, I tip my hat at you. Well done, everybody, and stuff. The reality is that what you'll find is that if you've got a high reward to risk ratio for asymmetric trade, so 4 to 1, 5 to 1, 6 to 1, 7 to 1, 8 to 1, 10 to 1, etc., well, then your strike ratio is likely to be much lower, and it is about being comfortable with that. And that, as we'll see in the next slide or two, can be kind of challenging for many traders, right? What I tend to find, okay, for most traders is that they find they hit a comfort spot of around about 65%, all right? They are comfortable being right 2 times out of 3 and taking one loser. That's what I find is a comfort spot, okay, for many traders, all right? Once again, if you have the risk to reward ratio, all right, let's say above 1 to 1, well, then that can work for you. That can work for you and give you positive expectancy. But as I said, part of trading in general is about learning about yourself. It's about facing your fears and overcoming them. Okay, and as we'll touch on in a couple of slides, you know, part of that is about managing your trades correctly, and we'll talk a bit more exactly how we can physically do that. But what I want you to do is just, if you're not thinking about it, if you're a new trader, you have to start understanding, you know, that relationship between your win rate and your reward to risk ratio, right? And does that provide you with positive expectancy? Something we'll touch on deeper into the sessions. So, as I said, I like to go for asymmetric, all right, okay, reward to risk trades. You know, on my intraday trading, I'm normally between about, you know, 1.8 to 2.5 reward to risk, okay, my intraday shorter term trades, okay. My longer term trading is, you know, it tends to be longer, tend to be aiming between 3 to 5 to 1, sometimes a bit more. But that's why I do asymmetric reward to risk, because as I said, it actually makes it simpler and easier for me, okay. I find it more comfortable in terms of how to trade. But what I have found is that many new traders, they've struggled to follow that, right? Because actually what we find is, and this is what's perhaps a little bit shocking and weird, is that you'll find many traders, they would sooner be right than make money, which is, you know, quite a shocking revelation, all right? But I see it time and time again. Traders would sooner be right, okay, than actually be profitable as a trader. And that's got nothing to do with markets. That's all to do with individuals' internal ego, all right, their insecurities, their self-belief, all right, or lack of it, okay, you know, and also just conditioning, the conditioning from the way, you know, society conditions us to read, you know, if you think about it, when you were at primary school, you know, first school and stuff, you know, if you were you know, if you were right, you know, 8 out of 10, 9 out of 10 in a test, well, then, you know, you got fated as the star child at school. If you got 2 out of 10 right in the test, well, then basically, you know, you're thought to be a little bit special, all right, and you had to go and sit in the bad corner, okay, because you only got 2 out of 10 in the test, etc. But here's the thing: when it comes to trading, you can be enormously profitable on 2 out of 10 right, okay, and you could actually be, you know, make huge losses, but be right 8 times out of 10, as we said before. If the reward to risk ratio isn't right, you can still be, you know, struggling, even though you might have a higher win ratio. And this is what you find, okay. And my takeaway for yourselves is to take a little bit of time to sit and consider that. If you find yourself, all right, okay, changing your rules, okay, breaking your rules in a trade because you feel the need to be right more than to be profitable, well, then it's time for you to sort of have a little sit down and a chat with yourself, look in the mirror and reflect upon your behavior as a trader, because that will not help you as to be a long-term successful trader. Okay, now that will be challenged if you feel a need to be right more than you need to be profitable. You're a trader, okay, you're here to manage risk, okay, you're here to engage in markets in an effort to build a profitable trading business, okay. It's not about you being right, okay. If you need to be right and if that's what drives you, well, then you might need to spend a little bit of time reflecting upon that and finding ways to mitigate that particular let's say that particular mental and performance challenge, shall we say, okay. And it's not always, that's, that can be a challenge in itself. And this is why having things like trading buddies, okay, trading groups, trading communities, trading coaches, etc., can help you with that, okay. And there are always ways and means to do that. So when it comes to actually physically managing our trades, okay, we've talked a lot about, risk reward and the effect it has, but when it comes to actually physically managing a trade, we've taken a trading position, we've decided that, we're going to engage with the market. Well, I generally tend to believe that, we have kind of 2 ways to manage reward, okay, we manage risk, we put our trade on, we put our stop loss in place. Then we're looking at the flip side of risk management, which is about reward, all right, managing our trades. And I think we've got really 2 ways that you can do that. Your trade is either going to hit a target, you're looking to hit a target, or you're going to be using your stop loss, which will move from being a stop loss to being a trailing stop profit as the trade moves in your direction. Okay, so there are lots of variations of that, but if you boil it down, that's what you get. You're either going to have a target or you're going to have a trailing stop, all right, as a general rule. So when it comes to managing your trade, if you have a target in place, all right, okay, well, there are some benefits of it. You might get a feeling of certainty in an environment that is desperately uncertain. Namely, you have certainty as in you have a target and a target to aim for. It also allows you to go hands off. Once your trade is placed, once your order's placed, once your stop loss is placed, once your target's placed, well, effectively you can go hands off. And for many traders, this is actually better for them, right? Okay, it's better for them rather than to be sat there watching every tick on the chart, because it just is likely to sort of make you want to sort of interfere. That means that effectively, if it's hands off, all right, that also means you've got less time, okay, less time that you need to be sat at charts, okay, because you will reach a point of diminishing returns. That means it will probably take up less of your psychological capital. Remember, when you put a trade on, all right, it's not just your financial capital that you put at risk. There's also your emotional capital, your psychological capital, all right? There's also less opportunity for you to interfere in your trades, right? I think it's sort of, hinted a little bit earlier, is that, new traders, by their very nature, they're excited, they're learning new skills, they want to see how their trades, playing, how their decisions are working out. And so invariably they can sit there all day watching that trade. But the more they watch it and watch the sort of maneuvering of the sort of candles left, right, and center, it just sort of draws on them to want to interfere, okay, to actually get on board and to interfere in that trade. Generally speaking, for new traders, that's actually probably not a smart thing. All right, you are in fact creating the wrong habits. So, with a trade, as I said, the flip side of that is that with a target, it can be easier to follow. All right, it can be easier to follow because the trade is on. You could almost fire and forget. Okay, once you know and check that the entry order is in the right place, okay, with the right position sizing, that your stop loss is in the right place, and your target, okay, it can be there. And as we said there, if it's an asymmetric target, if you're risking, let's say, $100 to generate $300, okay, and your target's in the right place, that makes sense. That can be, that can be a simple, easy way for you to just fire and forget on the trade. On the flip side, all right, some traders prefer to have a trailing stop, okay? Their initial stop loss will get moved as the trade moves in their direction. That stop loss becomes a trailing stop profit, all right? What is the benefit? Is it's a little bit like there's a fishing trawler there, okay? Is that you're looking to stay with the trade longer, okay? And when you get on board and you're in a great trend, that allows you to stay with that trade longer, allowing you to trawl and hopefully sort of have a more profitable catch, so to speak. That allows the opportunity that there is a possibility, all right, not the certainty. There's nothing certain in trading, but the possibility of higher profits. Some traders also believe that it gives them the locus of control. And I would debate this myself, but, I'm just sharing ideas and thoughts with you. And what does that mean? Is that it means that by them having to engage with the market, by them having to maneuver and move their stop loss, it gives them a feeling that they are in control. As I said, I would probably debate that myself. I can understand that, that humans like to feel that sense of control, that, they're in control of this, control of the market. I can assure you, you are not and never in control of the market. But I can understand that some people would feel that they have a control of their position, right, by actually moving their sort of stop loss in line with their plan. Gives them a feeling of a locus of control, that they have some element of control, which for some people is actually easier to follow. Having just, fire and forget target on a trade might actually sort of just, generate some sort of anxiety, whereas being able to engage with it, being able to move the stop, gives them a feeling that, they are doing something, they're engaged, and that is easier for them to follow. And that's, that breaks out into a sort of a deeper, longer conversation, okay, about that. And maybe it's something to think about here for those of you joining us here today. How many of you at present in your trading use a target? How many at present use a trailing stop? What do you do? What do you do, and why do you do it? Okay, why do you think you do it? So, maybe, your own trading, put that in the chat box, just to think about that. Okay, do you use a target at the moment, or do you use a version of a trailing stop? Be interesting to know what you do yourselves in terms of ways to manage your own particular trading. So, of course, not unsurprisingly, I'm always asked the question, which one's best? Which is the best one? And what I'm here to tell you is that there is no perfection. Okay, neither one of them is necessarily better than the other. All right, it's both have their pros and cons. All right, for myself, I'm an ex-Air Force guy. Air Force guys, we love to hit a target. Okay, that's that's trained into you. Okay, you want to hit a target. Okay, whether it be with a missile, a gun, a bomb, whatever, you're looking to hit a target. So for myself, I tend to utilize targets. All right, 8 times out of 10, I'll utilize targets. Okay, especially on my shorter term intraday trading. Okay, I'll just have a target because I have almost that ability to fire and forget. I know where I'm getting in. I know where I'm getting out from wrong. I know where I'm getting out if the trade plays out. All right, it's simple. Fire, forget, less interference. Bosh, trade is on. I can work with it. Okay, so that suits me. Okay, and I've learned that over years of trading and keeping good records and analyzing my trades and finding out which one I'm able to do consistently well, trade after trade after trade. Others here joining us will have a different opinion. You might find that you just prefer trailing stops, okay, because you're happy and comfortable to try and run a winning trade as long as you possibly can, okay. And certainly some of those sort of longer term traders I worked with, at times they would do that well, and they may only have 4 or 5 really great trades a year, but those trades just generate everything for them. So as I said, there's no perfection, all right? And I'll show you 1 or 2 examples of that. It is about what works best for you. Okay, what works best for you? All right, that is crucially important. Okay, what is it that works best for you? What is it that you can actually consistently execute trade after trade after trade? So Raquel says, I use a target, don't like a trading stop, trying now to set it and leave it. That's excellent. I really appreciate that. That's great. Okay, that's great to hear your own feedback from your own experience of trading markets. Right, you don't like trailing stops, and that's what makes a market, because there will be plenty of people watching this here and now or watching this later who would love trailing stops. Okay, and that's absolutely fine. As I said, there's no perfection. They both have their pros and cons. It is about which one works better for you. Which can you, all right, consistently trade, execute flawlessly, trade after trade after trade. That is what's important. So thank you for that, Raquel. That's much appreciated. So, as I said, I put this chart up before, this is one of my own trades from a good few years ago now, but, it's on the weekly chart on the dollar against the Japanese yen. And my trade was here. I was entering down here. Okay. So as price was starting to trend, it had a little bit of a pullback. And then my target was here just in front of the 200 period moving average. And that trade was, it's nice. It was successful. It generated 3.7 R. Okay. An asymmetric reward to risk ratio. Okay, so a good trade, a happy trade. But actually, as you can see for yourself, that big weekly trend went on for months and months, and invariably I could have actually produced, I think a friend of mine traded and got about 35 R out of that particular trade. Okay, as I said, there is no perfection. All right, there is no right or wrong. If anybody tells you that that they have the perfect strategy or the perfect system or the perfect way to manage trades, there is no perfection. Okay, it's about what can you do trade after trade to do it consistently. That's actually where the key element is. So I had a very nice winning trade, but boy, it could have run. So someone who was trailing a stop there would have done much better than me on that trade. As I said, there is no perfection. All right, there is no perfection. That happens to everybody. Welcome to trading. So, if you are going to use a trailing stop, well, then you get into a conversation about, well, how should I trail my stop, Paul? What do I do? What are the ways I can do it? So I have a couple of examples here. This is, the recent maneuvers on the euro against the US dollar on the weekly chart. You can see that is in a very, very nice trend, a very nice trend. Okay. And longer term, as I said, longer term trading, we want to be trend traders. But what that also gives us is the opportunity to trail our stop using fractaled, okay, a piece that something that we will utilize and talk about in a future session. But you can probably see here, wherever there is a fractal created is where the initial trailing stop gets moved to, okay. So as the price moves in your direction, pulls back a bit, forms a fractal, the stop loss gets moved from there to there, okay. Price moves down, it pulls back, it forms another fractal there, the stop loss gets moved to just above there. And it actually does that, okay. You can see it basically as it steps its way down, it moves its way down until we see that basically price trades through. All right, this is the last of the opt fractals. If you think some people might have even traded that off the swing. If you're just using a simple fractal, it's just very simple. Once price trades there, that is actually where your trade is taken out. So invariably, getting short on the kind of the initial pullback allows the opportunity to basically to stay with that trade. In that particular case where you get a great trend, that's an opportunity, okay, to sort of just ride that trend as much as possible until you're taken out. Now, some people will look at that and say, but Paul, this was the low here, we get taken out here, I gave back all of this profit. Yes, you did. Welcome to trading, okay. Trying to pick the exact top and bottom of a maneuver is a bit of a mug's game, okay. And if you're trailing, what you're looking to do is to run as much as possible, but you also have to realize you're going to give some back at the end, okay. You're going to give some profit back at the end. That is why, because you're giving you the winning trade the room to maneuver, okay. So that's there, looking at there as fractals. Or maybe you can do something here in simple, okay. So, other traders I know will use the average true range, okay. They use the average true range and the 20 period moving average. And what they will doing here is they will effectively work out what the average true range is, and then basically they will halve it, all right. So I think for a lot of that time around euro dollar, it was around about the weekly range was, I think, around about between about 170 to 200 pips. Half of that, let's call it 90 pips, okay, 90 pips. And so what would happen is once the initial trade was entered, well, then basically what would happen is that the trader would trail a stop about 90 pips behind the 20 period moving average. So, you manage to stay in the trade here when it just closes above the 20, but also that means you're taken out here, okay. So once again, you've given a good bit back, but you've had the opportunity to basically to trail that, all right. And so they're just trailing at half the weekly ATR behind the 20 period moving average. It's quite mechanical. It's relatively simple on a weekly chart. You're effectively just updating it, okay, as you go, all right. And it allows them to do that, all right. So that's one way that you could actually trail your stop. And finally, if you really want to, very simplistic, you can use a simple indicator, which you'll find on the Admiral's MT4 and MT5 platforms, PSAR, okay, the support and resistance indicator, and a parabolic support and resistance indicator, and maybe hopefully you can see that if you're joining us at home, all right, okay, it's just dots. So once the trade is in, you'll basically stop is moved to where the dots are, okay, so effectively you're doing that. The thing is that, when the dots swap, well, then, so you should be getting ready to get out, okay, which means you might be taken out of, a very long trend earlier than you particularly like. As I said, there is no perfection. There is no, there's no perfect way that's going to capture every pip of every trend. You're just going to fool yourself trying to do that. But PSAR might be simple because it is just mechanical. It tells you where it dots, that's where your stop loss moves to, okay? So it makes it mechanical. It makes it easy for you to follow. It's not perfect, but it's easy to follow. And that is actually more important about being consistent. So when it comes to managing your trades, what you're looking at, all right? The important thing I want you to take away is decide on your approach before the trade is even placed, all right? If you have a target, make sure you've got a positive target idea, two times reward to risk, okay? Asymmetric reward to risk. And if you're going to trail, well, make sure you have just a very suitable trailing strategy. I've just shown you the three there, using fractals or using the ATR behind a moving average, or you're just even using a simple indicator like PSAR. The important thing is decide on your approach before the trade is even placed. That is the key element, okay? Find some traders, they'll start with a target and then they think the trader is going to move, and they'll basically sort of just swap to having a trading stop, or they've started with a trading stop and the market's looking a little bit sluggish and they think, oh, I'll just have a shorter target. Do that. Don't be doing that. Okay, decide on your approach before the trade is even placed. Why is that important? Because if what you're doing there is, if you're just constantly changing in a live market, you will make impulsive knee-jerk reactions based upon what's going on in the market. Furthermore, you'll be just sort of setting the kind of wrong habits, the habits that, you know what, you can just break your rules as and when you feel like it. And that is not a good way to be operating as a new trader to begin with. So a couple of final points, all right? Regardless of which one you choose, whether to have a target or whether to trail a stop, plan the trade and trade the plan. Do not let your reward be decided when the trade is open, all right? Don't be trying to change tacks once the trade is up and running, all right? Have a plan, stick with it, okay? Find something that is easy for you to consistently repeat, and think about samples of trades rather than the outcome of one, right? Because I find people will change their rewards, okay, their exits, trade by trade based upon recency bias of what happened in the last trade. That's not ideal for you either, ladies and gentlemen, all right? Okay, what we want to be able to do is to just have a simple plan, follow it, and think of it in samples of trades, maybe blocks of 20 trades. So, have 20 trades where you just have a target, okay, and a set target, and you work with that. Maybe you have a sample of trades where you trail, okay, using fractals and see how that works, okay. Can you actively execute that plan for 20 trades, all right? If you can't, that in itself is giving you some great feedback. So in conclusion, ladies and gentlemen, it is very important to manage risk as a trader. You will have heard me talk about that consistently. However, you also need to manage the other side of the equation, namely reward. And generally, all right, we can do that in one of two ways. Either have a target or a trailing stop, okay? There's lots of variations on it, but it tends to boil down to that. Neither are perfect. They both have their pros and cons. Don't let anybody tell you that one is, the perfect way to do it. There is no perfection. What's important is to pick one before you even enter your trade. Don't change it during the trade, okay? Find the one that is the easiest for you to follow with discipline every time you place a trade. That is actually the key important thing, ladies and gentlemen, right? Being able to just be consistent and disciplined in how you employ that plan, trade after trade. So there you go, ladies and gentlemen. As we sort of draw to a close, just a reminder that the next of the Ultimate Price Action Guide, next Wednesday, 7th December, 2 o'clock London time. I'm going to talk about, should we be trading pullbacks or should we be trading breakouts? Okay, both two sort of variations of trading styles, and we'll look at it through the prism of price action trading. What can we do and how can we utilize that? For those of you who are new to trading, we'll talk about what's the difference between pullbacks and breakouts. How do traders identify and trade them, and what are the best setups, all right? What are the best setups? So that's 2 o'clock London time, Wednesday, 7th of December. Check your inbox or head over to the Admiral site to sign up for that. If you've got any questions for this, if you've been watching this session, you can, of course, do that. You see the email there, global@admiralmarkets.com. Please just, send a message to them. You'll also get a little feedback form after this session. If you can take the sort of 20 seconds just to fill that out, we'd really appreciate that. Would be excellent, ladies and gentlemen. We'd really look at that. Okay, that would be grand. And ladies and gentlemen, unfortunately, here we go. Unfortunately, ladies and gentlemen, we're kind of running out of time. I was going to have a little look at the live markets, but I wanted to really focus on making sure that people understood how to manage your trades, to effectively just to recognize the importance of managing reward to risk, and also about whether you have a target or a trailing stop. And the important one being that you recognize neither of them is perfect. It's which one can I do consistently, trade after trade after trade. That's the key thing, ladies and gentlemen, right, at this stage of your trading journey and career. So I hope you found that useful. I hope that's given you a little bit of food for thought, a little bit of insight, and a little bit of knowledge that you can utilize in your own trading going forward. As always, I wish you the very best of success in your own trading, ladies and gentlemen, and I look forward to speaking to you soon. Take care, everybody, and trade well. Cheers.